Well, good morning. Joginder Rana here. So, the topic of the day is tax benefit on insurance policies. Tax benefit on insurance policies. Purchasing life and health insurance policies is a must, especially if your spouse and children are dependent on your income to survive. Even if your spouse is earning, it would be a good idea to cover your life through this, though this cannot make up for the emotional loss, but at least your family members will be financially secure. So a life insurance policy is a contract you enter with the insurance company. You pay periodical premium to the insurance company in exchange for a gross amount payable on your death to your spouse and children, that is death benefit, and or receive maturity proceeds up and completion of the insurance term, that is maturity benefit. So many life insurance companies in India offer hundreds of plans for various needs and age groups. While choosing a plan, you also need to consider the tax implications of taking a life insurance too. So as far as the insurance policies are concerned, buying insurance policy helps one to save tax. Let's understand this with an example. Suppose the taxable portion of your income amounts to rupees 5 lakh. This means that your tax liability for the year would be computed for rupees 5 lakh based on your income bracket. Thus, if a certain investment option is set to give a tax benefit up to rupees 5 lakh per year, for example, then this rupees 50,000 is deducted from your taxable income. That is rupees 5 lakh. Thus, your tax liability would now be calculated on rupees 4,50,000. So, the more tax saving option you invest in, the lower your taxable income becomes. It is recommended that you look up a variety of tax saving options spanning different sections of the Income Tax Act 1961 to reduce your taxable income component considerably. So as per Income Tax Act 1961, buying an insurance policy gives the taxpayer an option to save tax and reduce the tax liability. Following are the tax advantages available to the insurance policies holder. The first one is life insurance tax advantages. So in a life insurance policy, the insurance company promises to pay a certain sum of money, known as sum assured, to the nominees of the insured individual should the individual pass away during the policy period. So if the individual outlives the policy period, some policies, more specifically endowment, money back, whole life policies, pay out maturity benefit to the insured individual. So Section 80C says premiums paid on a life insurance policy like endowment, whole life, money back policies, term insurance policies, and unit linked insurance plans qualify for tax deduction under Section 80C of the Income Tax Act 1961. So the maximum deduction that can be claimed is rupees 1,50,000. For tax deduction under Section 80C of the Income Tax Act 1961 on life insurance can be claimed for premiums paid towards insuring self, spouse, dependent children, and any member of Hindu undivided family. So an important point to be noted is that if the policy is issued on or prior to March 31st, annual premium up to a maximum of 20% of the sum assured becomes tax deductible. For insurance policies issued on or after April 1st, annual premium up to a maximum of 10% of the sum assured is tax deductible. So Section 80CCC says tax deduction under Section 80CCC of the Income Tax Act 1961 can be claimed for amount paid towards any annuity plan of Life Insurance Corporation of India or other insurance companies for the purpose of receiving pensions. So the maximum deduction that can be claimed under this section is rupees 1,50,000. Then there is section 10(10)(d). So 10(10)(d) of Income Tax Act exempts you from paying taxes on the amount that you receive from the life insurance provider. Under this section, the amount of sum assured and bonus, if any, received on maturity or surrender of policy or on death of the life assured are completely tax-free in the hands of receiver, subject to certain conditions. So similarly, health insurance policies are also entitled for the tax benefits. This is an example of life insurance. Health insurance policies are also entitled. So health insurance tax advantage says in a health insurance policy, the insurance company will cover the cost of an insured individual's medical and surgical expenses in the event the individual falls ill or get injured. Here again, Section 80D, the tax deduction under Section 80D of the Income Tax Act 1961 can be claimed for premiums paid towards a health insurance policy. So the total deductions that can be claimed under Section 80D are self and family, for self and family, that is rupees 25,000, self and family and parents, for rupees 50,000, that is 25,000 plus 25,000. Self and family and parents, senior citizens, 75,000, that is 25,000 rupees plus 50,000. Self, senior citizen and family plus parents, senior citizens, rupees 1 lakh, rupees 50,000 plus rupees 50,000. And the limits are subject to revision every year. So a tax deduction of up to rupees 5,000 can be claimed for expenses borne on medical checkups or preventive health checkups within the above limits. Now the tax deduction for senior citizens has been raised to rupees 50,000 from rupees 30,000. Tax benefits under Section 80D can also be claimed for premiums paid towards health insurance, riders and critical illness insurance policies. It must, however, be noted that premiums paid for personal accident policies or personal accident riders do not qualify for tax deduction under this section. So the conditions associated with claiming tax benefits on life insurance or health insurance policies says, although you can make premium payments in cash for your health insurance policies, you will, however, not be able to avail tax benefits on it, as the income tax rules would disallow tax deductions on premiums paid via the cash mode. So it is thus recommended that you choose to pay premiums through checks, internet banking, draft or credit card to enjoy the tax advantage on premium. Cash payment for preventive health checkups are eligible for tax deductions under Section 80D. So to claim tax deduction under Section 80C, make sure that the premium paid during the financial year does not exceed percentage prescribed, that is 10% of the sum insured. If it crosses this figure, it should be noted that the benefits you can claim will be limited up to 10% of the sum assured. In case of Section 10(10)(d), tax exemption is subject to premium not surpassing 10% of the sum assured. So the tax deductions under Section 80C and 80D can be claimed only for those years that you have paid the premiums. In case you have opted for a single premium life insurance policy, you can only claim tax benefits under Section 80C once, which will be the year you pay the premiums. So here Life insurance policies offer maturity, death benefits, and tax deductions under Section 80C and Section 1010D of the Income Tax Act of 1961. For the tax deductions provided under both the sections for life insurance policies is applicable now. So, for example, exemptions under Section 80C is to be availed. If you have paid an insurance premium to insure your own life or the life of your spouse or child, such premium payments are eligible for deduction under Section 80C of the Income Tax Act. Irrespective of your child being dependent or independent, minor or major, married or unmarried, the deductions under Section 80C shall be allowed. An individual and a HUF can claim this deduction under Section 80C for life insurance premium paid up to rupees 1.5 lakh a year. This deduction is available along with other eligible items like NSC, PPF, fixed deposits, ELSS, tuition fee paid, home loan, repayment, provident fund contribution, etc. So many taxpayers doubt whether this deduction is available only in respect of life insurance cover taken with LIC. No, this is not true. Premium paid towards a life cover taken with any insurer approved by the Insurance Regulatory and Development Authority is eligible for Section 80C deductions. Similar is the case with exemptions under Section 1010D on maturity amount received. So when the premium paid on the life insurance policy does not exceed 10% of the sum assured for policies issued after 1st April 2012, the amount received on death of the insured or maturity or surrender of the life insurance policy is fully exempt from the tax under Section 1010D. Even the amount received as a bonus is exempt from tax under this section. However, when the premium paid on the life insurance policy issued before 1st April 2012 does not exceed 20% of the sum insured, any amount received on maturity of a life insurance policy or amount received as a bonus is fully exempt from Income Tax Act under Section 1010D. Those situations where maturity amount of policy is taxable as per Section 1010D in case of life insurance policy issued after 1st April 2003 but on or before 31st March 2012. If the premium payable exceeded 20% of the actual sum insured, the maturity proceeds are taxable in the hands of the insured. So, in case the life insurance policy is issued after 1st April 2012 and the premium payable exceed 10% of the actual sum assured, the maturity proceeds are taxable. In case the life insurance policy is issued after 1st April 2013 on the life of a person with a disability or a disease specified under Section 80U and 80DDB respectively, if the premium payable exceeds 15% of the actual sum assured, the maturity proceeds are taxable. However, please note that in case of the death of the insured, where the nominees receive the policy maturity proceeds, it will be tax-free in the hands of the nominees, even if the premium paid in any year crosses the above prescribed percentage of the sum insured. So if the amount received from a life insurance policy is more than rupees 1 lakh on policies not covered under an exemption under Section 1010D, then TDS at the rate of 5% shall be deducted by the insurer before making this payment. TDS will also be deducted on bonus payment. So if the amount received is less than rupees 1 lakh, no TDS shall be deducted, but the amount received shall be fully taxable for you. You can claim credit for the TDS deducted in your income tax return. Thank you very much.